When the Fed prints money, and we're not talking about physical paper, we're talking digital trillions created in a split second with a keystroke, someone always gets paid first. Always. And the order in which that money enters the economy determines who benefits, who inflates, and who gets left holding a smoldering bag of worthless dollars. This concept has a name, the Cantillon Effect, named after an 18th century economist, Richard Cantillon. And it's the single most important idea to understand if you want to see who's really profiting when the money printer goes brrr. Because it's not you. And it's not me. It's the insiders, the whales, the primary dealers, the politically connected. It's the people sitting at the front of the buffet line when the Fed starts serving hot money and everyone else gets the crumbs after inflation has already jacked up the prices. Now let's break this down, step by step, because once you see the full pipeline, it's game over. The veil lifts. You start to see the dollar not as wealth, but as a weapon that's been used to systematically funnel purchasing power upward. All right, step 1, money creation. The Federal Reserve doesn't literally print most of the money. Over 97% of the money supply exists digitally. It's typed into existence by the Fed buying assets, usually treasury bonds or mortgage-backed securities from commercial banks or designated dealers. These are known as primary dealers. There are 24 of them. Ever heard of them? Probably not. But these firms, Goldman Sachs, JP Morgan, Citigroup, Morgan Stanley, BNP Paribas, sit at the absolute top of the monetary food chain. When the Fed creates money to buy an asset, who does it buy it from? These guys. So the first people who get access to new money are the primary dealers and the commercial banks. And here's where the Cantillon effect kicks in. That newly created money hasn't caused prices to rise yet. It's fresh, pre-inflation capital. So the people who spend it first get the full purchasing power. By the time that money trickles down to regular folks to you, buying groceries or trying to afford rent, prices have already gone up. You're using inflated money to pay inflated prices. But they used pristine money to buy assets before those prices exploded. You see the scam? It's time arbitrage. They got the jump, and you got the lag. And it's not some minor quirk, it's the backbone of the whole system. Let's look at an example. In 2020, the Fed launched the largest asset buying spree in history. They added $3.3 trillion to their balance sheet in just 1 year. That's more than the entire amount of money created during the first 95 years of the Fed's existence. And where did that money go? First to the banks, then to Wall Street. The Fed bought $1.3 trillion in mortgage-backed securities, pushing down mortgage rates. That money flooded into real estate markets, inflating home prices by 19.2% in 2021 alone. Did your wages go up 19%? No? Then congratulations, you just got priced out of a home by a hedge fund using money created yesterday. The Fed handed Wall Street a loaded cannon, and you brought a spoon. Now let's talk about asset holders. People think inflation hits everyone equally. Wrong. Inflation is not a uniform tide. It's a storm with a preferred direction. If you're holding real assets, stocks, real estate, private equity, new money drives those prices up. That's why the top 10% of Americans own over 89% of the stock market, and they cheered as the Fed printed trillions. Their portfolios soared. Their homes doubled in value. Meanwhile, the bottom 50% of Americans have negative net worth when adjusted for inflation. They don't own assets. They own debt. And every new dollar printed dilutes their purchasing power. So let's be very clear. When the Fed prints money, it's not neutral. It's targeted. It's wealth redistribution. From the poor to the asset-rich, from labor to capital, from savers to speculators, from renters to landlords. But wait, it goes deeper. Because the Fed doesn't just buy assets. It also backstops credit markets. In 2020, the Fed stepped in to buy corporate bonds. Not just any bonds, junk bonds. Bonds rated below investment grade. And who issues those? Risky corporations like Hertz and Carnival Cruises. Companies that would have gone bankrupt under normal market discipline. But the Fed said, "Don't worry, we got you." They set up the secondary market corporate credit facility and funneled money to BlackRock to manage the purchases. Let that sink in. The Federal Reserve hired BlackRock, the largest asset manager on Earth, to buy corporate debt with newly created dollars, using a BlackRock-designed ETF. So BlackRock got paid to buy their own products, using money the Fed created. Conflict of interest? No, that's just modern monetary policy. Oh, and BlackRock isn't even one of the original 24 primary dealers. They just sit on so many advisory panels. Central banks don't even pretend anymore. Now think about velocity. That's the speed at which money moves through the economy. When the Fed prints money, it enters the system through the banking sector. But banks don't hand out cash to you. They lend. And they lend based on profitability and collateral, not need. So who gets the new credit first? Corporations, real estate developers, private equity firms. They borrow at 0.25% interest. They buy apartment buildings, raise rent, and you get hit with a 40% rent increase while your wages grow 2%. Again, the scam is structural. The people closest to the Fed get capital at the lowest cost. By the time you see any of it, you're paying triple. Let's make it even more concrete. In 2021, the Fed was buying $120 billion a month in Treasury and mortgage bonds. That injected roughly $1.4 trillion into financial institutions annually. During that time, Blackstone, the largest private landlord in America, raised $30 billion to buy single-family homes across the country. Where did that money come from? Institutional investors flooded with Fed liquidity. Meanwhile, first-time homebuyers got outbid by faceless investment firms paying cash. If you ever wondered why it's impossible to buy a home right now, this is why. The Fed prints, the institutions scoop, the prices soar, and your dream of home ownership turns into a Zoom call with your landlord's chatbot. Who gets paid when the Fed prints money? The people who don't need it. But here's what they never tell you in Icon 11. Every dollar the Fed creates has a mirror image. Someone's asset is another person's liability. When the Fed buys treasuries, the government receives cash to spend. But that cash becomes debt. Debt with interest. That interest gets paid to the Fed, which then, after a small dividend to the member banks, returns the profit to the Treasury. Sounds circular, right? That's the shell game. What doesn't get returned are the asset gains from the private sector. When JP Morgan sells a bond to the Fed, they book a gain. When they lend that money out at 8% interest, they collect the spread. When they use it to buy stocks, they benefit from the Fed's forward guidance. In 2021 alone, S&P 500 companies spent $881 billion on stock buybacks. Why? Because cheap money from the Fed made it more profitable to buy their own shares than to invest in workers or factories. Buybacks drive share prices up, executives cash in their stock options, and you, dear taxpayer, are told it's stimulus. It gets even worse. Because once the money is created, it chases yield. That's how speculative bubbles form. Ever wonder why NFTs selling pixelated rocks hit $1.3 million? Or why Dogecoin, created as a joke, briefly reached a market cap of $90 billion? It's because the Fed flooded the system with so much liquidity that rational investments ceased to matter. In a world of zero interest rates, capital behaves like a teenager with a Red Bull and no supervision. It doesn't care where it goes, as long as there's a pump. And when the crash comes, who gets bailed out? Not you. Never you. Silicon Valley Bank collapsed in 2023 because it was stuffed with low-yield bonds purchased with customer deposits. When rates rose, the bonds cratered, and the bank imploded. Did the Fed let it die? No. They stepped in with a $25 billion bank term funding program, letting banks swap underwater assets at face value. Translation? The Fed said, "Don't worry about your losses. We'll print away the pain. So let's stop pretending." The Fed doesn't operate in the public interest. It serves the banking sector, the asset class, and the investor class. Every time it creates money, it decides who benefits. And it always chooses the same people, the ones at the top, the primary dealers, the commercial banks, the asset managers, the politically connected. If you're not on that list, the Fed's money printing is not stimulus. It's extraction. It's inflation in disguise. It's taxation without legislation. And the worst part? It's completely legal. Enshrined in a system built to favor capital over labor, ownership over work, and debt over savings.